I am happy to recall that Professor Pamidua was an esteemed member of the first MPC, and the Reserve Bank benefited immensely from her distinguished academic rigor and practical insights. I'm also happy to see in the audience Professor Chetan Ghate, who's here, and he was also a member of the first Monetary Policy Committee, from 2016 onwards. The decisions of the MPC are taken by a majority of votes among the members present. In the event of a tie, the governor has a second vote or a casting vote. After the conclusion of every monetary policy meeting, the Reserve Bank publishes the resolution adopted by the Monetary Policy Committee. In addition, the governor's statement and press briefings are the other modes of policy communication. The minutes of each of the members of MPC are also published exactly after 2 weeks of the conclusion of the Monetary Policy Committee meeting, and that is provided for in the law in the interest of greater transparency. Similarly, every 6 months, the Reserve Bank comes out with a monetary policy report which broadly captures the way the monetary policy has evolved, the way the macroeconomic situation has evolved over the previous 6 months. Now, all these provisions add to transparency of the whole process and better communication of the whole process. Now, this is a forward-looking monetary policy, and which has therefore underlying which is the importance of forecasting. So I would now like to therefore focus on aspects of the forward-looking monetary policy and the importance of forecasting. As monetary policy works with long and variable lags, the forecasts of key economic variables play a vital role in the conduct of monetary policy. It is for this reason that inflation targeting framework is also termed as inflation forecast targeting framework. To take a real-life analogy, the conduct of monetary policy is like driving a car on a road with potential ditches and speed bumps. The driver needs to see them ahead and in time to regulate the speed of his car. Yes, to regulate the speed of his car and to negotiate the ditch or the speed bump smoothly. If the driver reacts suddenly to a speed bump, he runs the risk of losing control and causing an accident. Therefore, a successful conduct of monetary policy depends critically on credible forecasts of key variables like inflation and growth. In other words, monetary policy has to be forward-looking. Rear-view mirror can lead to policy errors. The forecasting process followed at the Reserve Bank has 3 broad components. They are nowcasting, short-term forecasting, and medium-term forecasting.